Welcome to another edition of Between Two Ferns. Zach Galifianakis is off today. Investor Beat starts now. Thanks for watching. I'm Chris Hill. Red across the board on Wall Street today. The Dow Index falling, despite the fact that McDonald's bounced back from yesterday's weak sales numbers. Joining me in studio today, Morgan Housel and Mike Olsen. Guys, it is the all-retail edition of Investor Beat. Let's start with teen apparel. American Eagle's fourth quarter profit fell 89%. Urban Outfitters got some pretty good Q4 results from Anthropologie, but sales are falling at the actual Urban Outfitters locations. And Mike, it's ugly out there for retail in general, but specifically teen apparel is just a really tough business.
Well, I mean, I think there are two sort of undercurrents in these earnings reports. The first is, as you say, teen apparel is a horrendously difficult business. Your consumers are extraordinarily fickle, and there's just no reason to believe that your cash generation in 1 year will approximate the next. The second, and I guess there are really two themes in this, is sort of the structural issues underpinning the teen market. Despite the broader recovery in unemployment, teens have remained chronically underemployed, and that's going to be something that will continue to pull at them because folks that are not employed find it more difficult to become employed. That's going to be a real problem for teen retailers as time wears on.
When you look at this industry, it really does seem, just from the perspective of the stocks, it seems like almost like a crapshoot where any one of them can be up in a given year, but any sort of sustained success is really hard to come by.
I think that's exactly right. And if you are an investor from that point of view, it's really hard. You either have to be a very patient, long-term investor or get lucky in the short run. And neither of those two strategies. The first strategy is good if you can stick it out. But it's so fickle in this industry. And who knows who's going to be around 10, 15 years?
You look at these two stocks, Urban Outfitters, American Eagle, they're both on the news today. They're both hovering around 52-week lows. Mm-hmm. You take a flyer on either of these?
You know, I think if you want to play in this sector, which admittedly, I don't think this is a place for long-term investors, Urban Outfitters has been one of the more exceptionally run retailers. Part of that is a stroke of luck on account of the fact that they landed right at the center of the hipsterish sort of trend. The other is that they've been remarkably intelligent about how they built out their e-commerce presence. So they're one of the few retailers which has done a good job of sort of concretely linking that e-commerce platform and the brick and mortar store.
All right, let's move on to men's apparel. At long last, the marriage has been consummated. Men's Warehouse is buying Joseph A. Bank in a deal worth $1.8 billion, and I'm assuming everybody loves this, Mike, because shares of both stocks are up today. Or are people just really, I mean, this is a soap opera that's been going on for a good 6 months or so.
I mean, this has been good theater, if nothing else. And I think that, if there's one group which emerged in this, if we're signing the sort of prenup in this marriage, it's Joseph A. Bank's shareholders. Joseph A. Bank's management somehow or another managed to extract 10 times EV to EBITDA. Now, this is for a retailer. Don't get me wrong, I actually think there are some intelligent elements to this deal. The first is that these two players were sort of nipping at each other's heels. It eliminates an element of irrational competition. They can more efficiently source product. That's on the cost and sort of supply chain end of the spectrum. And in addition to that, the Tux business has meaningful network effects. For each node you have, it's more valuable if you have other ones. The opportunity to cross-sell Men's Warehouse tuxes in Joseph A. Banks eliminates competition and also makes the network more valuable. 17 times cash flow, which is kind of the implied price. I'm not thrilled about it, but it is actually more interesting than it looks on its surface.
I'm not anything resembling someone who knows a lot about fashion, but I have to believe that this business is maybe slightly easier than women's fashion, just if for no other reason than guys like me, if we're looking for a suit, I just need a basic suit. I don't need
Suits are timeless. A nice suit from 1950 is a nice suit today. In terms of lowering competition, all I want to know as a consumer is whether buy one pair of socks and get 6 suits for free or whatever deals they have, whether those will stick around or not.
And I don't think they're going to stick around.
Again, looking at the stocks, does everything you just said about reducing competition, that sort of thing, does that make Men's Warehouse now a little bit more attractive in the long run?
Incrementally speaking, I think that is the case. That being said, retailing is still a very difficult business, and so you want to have a little bit more of a margin of safety before you wade into this.
All right, let's wrap up with general retail. J.C. Penney on the rise after analysts upgraded the stock to a buy on expectations that same-store sales will continue to grow in 2014. Not all analysts, these are the analysts at Citi.
Right.
Is this just a situation where the stock has just been beaten down so long, at some point it has to look attractive?
Well, maybe this is like one of Warren Buffett's famous cigar butt companies where there's a used cigar on the ground, you can pick it up and get one puff out of it, but that's all you can get and then it's done. Maybe that's Penney. There's still a little bit of life in it, but I think for long-term investors who really want to invest in good businesses, this is not where you want to be.
We were talking before we started taping, Morgan made the point about just how much bigger Penney was 20 years ago. It's still a really big company. Is this a situation where they really need to get a lot smaller before they can start to succeed, particularly if you're thinking about it from the standpoint of the stock?
You know, I'm not entirely sure what they can do to remedy things. The basis for today's up is that they're kind of going back to basics. They're focusing on what has worked. And the reality is we have no real unique insights surrounding their ability to bring customers back and what that will eventually be worth. Like Morgan said, I just think there are better businesses to put your money behind.
All right, let's see if we can find a couple of them. That's going to do it for today's action. And give me a stock I can put on my watch list.
Power plug, not to buy, just to watch, because it's a symbol of the insanity that is going on in the power market of basically the quest for the next Tesla. The stock's up 20% in the morning, down 38% in the afternoon. It's a good showcase of how much speculation is out there.
We've talked about this before. This is a stock that a year ago was trading for about 20 cents a share.
And then it was $11 this morning, and right before taping, I think it was $6, so maybe it'll be at 37 by the time the show's over. Who knows?
Okay, one to watch for the fun, but not for the actual purchase.
You know, I'm still watching paychecks. I think I've said this before. It's really interesting play in the sense of the employment market getting better and the possibility of interest rates rising. Both of those two trends help paychecks.
All right, what about you, Mike?
Right, I'm looking at Chiquita Brands. You probably saw yesterday they announced a tie-up.
Billion-dollar deal.
Billion-dollar deal between them and I believe it is Fifes, which would create the single largest banana producer. Now, depending upon what your source is, they either control 14 or 30% of the global banana market. Regardless of whatever it is, it's large. And that'll enable them to exert substantial influence over banana farmers in negotiations. And in addition to that, the extent of the consolidation you've seen in the banana industry looks like you're getting towards the point where you might have some nice oligopoly type dynamics. In that case, you would have producers acting a little bit more rationally, pursuing price over volume, recipe for good returns. Something I'm watching. I'm not altogether convinced it's there, but it's very interesting.
Possible monopoly here? Are we looking at Uncle Sam maybe like having to break up one of these big companies?
You know, I don't think that that'll actually happen, because if you look at the history of the banana industry, it made some pretty poor profits. So I think this deal will probably pass.
All right. For Mike Olsen and Morgan Housel, I'm Chris Hill. Thanks for watching. We'll see you tomorrow.